Weimar Germany, November 1923. Berlin wakes up to a number so absurd it feels like a prank from history. A loaf of bread costs 200 billion marks. A lifetime of savings, if it's sitting in currency, buys almost nothing. The bank account that could have bought a house in 1918 can barely buy bread in 1923. 5 years. That's all it took for stable money to become worthless paper. And yet some people survived. Some people even thrived. Not because they predicted the collapse with perfect timing. Not because they had insider information. They survived because they followed principles that survive every collapse regardless of the cause, the country, or the century. Argentina, 2001. The peso is frozen. Banks close. You can't access your deposits. Then the real shock. The government confiscates dollar accounts and converts them to pesos at a rigged rate. Overnight, you lose a massive chunk of your savings. In one moment, the public learns the brutal truth nobody teaches in school. Money is not just math, it's law, it's policy, it's power. And in crisis, power moves fast. America, 2025. National debt sits in the tens of trillions. The currency has been slowly hollowed out across generations. The central bank expanded the money base at historic speed in the early 2020s. And whether the next breakdown comes as inflation, deflation, default, capital controls, or a reset, the system is walking the same old path every collapsing empire walks. Too many promises, not enough real output, and a population that assumes the rules will stay the same. When the collapse comes, whether in 5 years or 15, the same principles will decide who survives and who loses everything. Here are the 5 financial principles that have survived every collapse in recorded history, why they work when everything else fails, the historical proof behind each one, and how to apply them now, before the window narrows. Understanding this isn't about getting rich. It's about not losing everything. Because in every collapse, most people lose everything, not because they're stupid, but because they follow tactics that work in normal times and fail catastrophically in crisis. Before I show you the 5 principles, you need to understand why principles matter more than tactics. A tactic is specific advice. Buy gold. Sell stocks. Hold cash. Buy real estate. A tactic might work. It might also destroy you. It depends on timing, on the specific type of collapse, on regulations, on bank solvency, on the mood of the crowd, on 1,000 variables you don't control. A principle is a fundamental truth that works regardless. Principles worked in Rome when gold and silver were money. They worked in Weimar when paper was money. They worked in Argentina when deposits became a hostage. They'll work in America whether the collapse looks like hyperinflation, deflation, bank failures, or a controlled currency reset. Most financial advice is tactical. Put 60% in stocks and 40% in bonds. Diversify. Dollar cost average. Trust the system. These tactics assume the system keeps functioning. They assume banks remain solvent, governments honor contracts. Courts enforce claims. Property rights remain stable. Markets stay open. In a collapse, those assumptions break. But the principles remain. Principle 1. Hard assets survive. Paper burns. When currency collapses, when governments default, when the financial system breaks, physical assets retain value because they're real. Paper assets, anything that's ultimately a claim on something else, can evaporate because the claim becomes unenforceable. Weimar, 1918 to 1923. If you held marks in a bank account in 1918, you were wealthy. By 1923, the same account couldn't buy a loaf of bread. Paper wealth didn't decline. It didn't correct. It vaporized. The numbers remained until they didn't matter. But people who owned hard assets survived. Land, buildings, factories, tools. A farm in 1918 was a farm in 1923. It grew the same food. It fed the same mouths. The mark price went from thousands to trillions, but the farm itself didn't change. Zimbabwe in the 2000s. Currency collapsed into absurdity. Savings died. But land produced food regardless of what the currency did. Livestock retained value because it could be eaten, bred, traded. Equipment mattered because it created output. Argentina, 2001. Bank accounts were frozen. Dollar deposits were forcibly converted. Paper claims became trapped inside the political system. But hard assets, things that could be held, used, rented, produced, were harder to rewrite with a signature. And now look at America. Most wealth is held in paper. Stocks are a claim on corporate earnings. Bonds are a claim on repayment. Bank deposits are a claim on a bank's promise. Retirement accounts are a claim on a financial machine staying coherent. In stable times, those claims work. In collapse, the system stops functioning. Banks ration. Markets freeze. Courts choke. Governments prioritize order over individual contracts. Paper assets become hostage to the rules. Hard assets remain. Real estate is still real estate. Gold is still gold. A farm still feeds people. A tool still fixes things. Paper burns. Hard assets survive. Principle 2. Own productive assets, not speculative assets. This is the difference between assets that generate value and assets that only have value because you hope someone else pays more later. Productive assets generate income, food, or utility independent of what anyone thinks. Speculative assets only have value if you can sell them. The Great Depression. Markets collapsed. If you own speculation, you were destroyed. But if you own productive assets directly, a farm, a rental property, a business that provided essentials, you still had production. You still had cash flow. You still had something people needed. A farm produces food whether the stock market is euphoric or dead. A rental property provides housing whether the news is calm or apocalyptic. A business that sells necessities continues to matter because human needs don't collapse just because prices do. In modern collapses, you see the same pattern. Some markets go up while society becomes poorer because the currency is dying. In those environments, the only real winners are people who control production. Food, energy, logistics, repair, healthcare, shelter. In America 2025, many people own assets that don't produce anything. They own symbols. They own narratives. They own things whose value depends on a buyer. And in a collapse, buyers disappear, liquidity vanishes, and your wealth becomes theoretical. When collapse comes, own things that produce value. Production feeds you. Speculation doesn't. Principle 3. Debt destroys you. In collapse, even good debt. In stable times, debt looks like leverage. You borrow to buy a house. It appreciates. You profit. The system rewards you for playing the game. In collapse, debt becomes a guillotine. Because your income can fall or disappear, but your debt doesn't. The bank still demands payment. If you can't pay, they take the asset. And suddenly you understand the darkest sentence in finance. If you don't own it free and clear, you don't own it. You rent it from the bank. Great Depression. Farmers borrowed through the 1920s to expand. Land prices were rising. Borrowing made sense. Then the crash hit. Crop prices collapsed. Income fell. But the debt remained fixed. Foreclosures swept entire regions. Families who had farmed land for generations lost everything, not because they were lazy, but because debt doesn't care. Argentina, 2001. Families with mortgages denominated in dollars watched their local purchasing power collapse while their obligations stayed hard. Same story. Income down, debt unchanged, default inevitable. Greece, 2010s. Incomes fell. Pensions were cut, unemployment spiked, but mortgage obligations still arrived every month like a metronome of doom. People will argue. Inflation helps debtors. Sometimes. But only if your income rises with inflation and the system keeps functioning. In real collapses, wages lag. Jobs vanish. Banks tighten. Governments impose controls. Inflation may reduce debt in theory, but crisis reduces income in reality. The safe position is resilience. Minimal debt, ideally zero on essentials. Because debt is leverage in expansion and suicide in collapse. Principle 4. Skills are the only truly portable wealth. Land can be seized. Gold can be confiscated. Money can be inflated. Businesses can be nationalized. Accounts can be frozen. Borders can close. Laws can change overnight. But skills stay with you. They live in your brain and your hands. They cannot be printed away. They cannot be easily confiscated. They are the one form of wealth that survives regime change. History proves it again and again. When entire populations were stripped of property, it was often the skilled who rebuilt first. Doctors, engineers, craftsmen, mechanics, electricians, builders, operators, people who could trade competence for survival. In revolutionary regimes, the state may hate the bourgeois, but it still needs bridges that don't collapse and machines that still run. Skills create leverage even under tyranny. In refugee waves, the ones who rise fastest are often the ones who arrive with skills, not assets, because assets are local. Skills are global. Skills are portable. They are rebuildable wealth. In America 2025, most people are wealthy on paper but fragile in reality. They can't grow food. They can't repair basic systems. They don't know how to produce. They know how to consume. In collapse, usefulness becomes a currency. Learn skills that produce value independent of complex systems. Repair, trade, operations, sales, medical basics, food production, technical work. Skills are the foundation of survivable wealth. Principle 5. Local trust networks outlast institutions. When systems collapse, institutions fail. Banks close. Governments lose authority. Police can't enforce order everywhere. Supply chains break. The legal system slows. The entire structure people rely on becomes unreliable, but local networks survive. After the Soviet Union collapsed, people survived through family, neighbors, informal exchange, and community coordination. The person with the strongest local network often did better than the person with the biggest bank balance, because the bank balance was trapped and relationships were liquid. Argentina 2001 saw neighborhood assemblies, barter systems, and local cooperation fill the void left by failing institutions. When the formal system breaks, society doesn't instantly dissolve it, regresses to what humans have always used: trust. Lebanon's crisis shows the same principle. When institutions weaken, communities, family, religious groups, neighborhoods become the infrastructure. Modern America has a unique weakness: institutional dependence with local isolation. You have a bank account but don't know your neighbors. You rely on mega retailers for food, but don't know local producers. You trust institutions but don't have fallback relationships. That's catastrophically fragile. Build local networks now. Know your neighbors. Create reciprocal relationships. Be embedded in community. In collapse, the person with strong trust networks doesn't just survive materially, they survive psychologically. Because isolation is expensive in normal times. In crisis, it's lethal. These are the 5 principles. Hard assets survive, paper burns. Own productive assets, not speculative. Debt destroys you in collapse. Skills are portable wealth. Local networks outlast institutions. Notice what's not on the list. Which stock, which crypto, gold versus silver, the perfect timing call. Those are tactics. And this is the beauty of principles. They don't require prediction. Most people make the same mistake. They wait for certainty. They want to know exactly when the collapse comes. But collapses don't announce themselves. By the time the public agrees it's happening, the exits are crowded and the rules are already changing. Principles don't require perfect timing. They require positioning, own hard assets. The collapse could come in 2030 or 2040. Hard assets still preserve value better than paper in crisis. Own productive assets. If the system stays stable, you earn income. If it breaks, you still produce. Eliminate debt. In normal times, you gain resilience. In collapse, you remove the bank's leverage over your life. Develop skills. In normal times, they increase your income. In collapse, they become your portable wealth. Build networks. In normal times, they enrich your life. In collapse, they become your survival infrastructure. These principles are ancient. They've survived thousands of years because they re-rooted in something deeper than headlines: human nature and mathematics. When debt exceeds the ability to pay, collapse follows. When currency is debased, paper wealth evaporates. When institutions fail, relationships matter. These aren't predictions, they're patterns. The American collapse, if it comes, won't be identical to Weimar or Argentina. The tactics that work will be specific to our time. But the principles remain unchanged. Hard assets survive. Productive assets generate value. Debt destroys. Skills travel. Trust networks endure. Position according to these principles now, and you survive what's coming. Ignore them and chase tactics, and you're gambling you can time history perfectly. That's a bet most people lose. If this showed you why principles matter more than tactics, why the same 5 rules survive every collapse, subscribe, because the next video will translate these principles into modern tactics for 2025 America. Which hard assets make sense in a digital economy? Which productive assets actually produce under modern regulation? How to eliminate debt strategically without self-sabotage? Which skills become most valuable when the system gets loud? And how to build local networks in a society trained to live alone? The principles tell you what to do. The tactics tell you how. These 5 principles worked in Rome, in Weimar, in Argentina, in every collapse. They'll work in America. The only question is whether you'll follow them before the window closes, or whether you'll wish you had after it's too late.